Thank you for joining me. It's Find Your Voice, and today we're discussing finding your voice in funding your startup. How do I mean by that? Is that everybody wants funding for their startup today, especially tech startup, and it's become the normal route through which people actually raise great companies. Many organizations or businesses or ideas have been able to go through the funding rounds and now built up properly as a real company that we can say can survive. While many died in the process. It's like, Formula One, you have too many cars on the racetrack and everybody's trying to run very fast and many are crashing. That's where things are right now. Some are, the assumption is you're driving the best of Mercedes and that you're going to win the race, but it looks like what they gave you had 3.5 tires. And accidents do happen. And we've seen many startups crash. We've seen many startups struggle. Some even have demonized their VCs and say, if I got a better source of funding, and if my VC is not a Shylock, or the VC has ulterior motive, and they wanted to take over my company, and that's why we did not thrive. All kinds of things out there. But today I have Daniel with me, who been a part of funding many organizations, runs a VC, and just plays in that space. And I also have Wale Onadeko here. Wale is an entrepreneur himself, plays in the agric space, has been involved with funding in agric, especially here in Nigeria. And then PD, Debo Omotunde, who is a consultant and who has also helped a few startups, also in tech, either to access funding or to prepare them to be a fundable organization. And he sits on the board of a couple of such organizations that are still very new and thriving. So, gentlemen, thank you for joining me today. And I really want us to dive into this discussion. So let me start with you, Debo. What's your take, generally speaking, especially with your experience with young startups and all, with the concept of funding for a startup?
Thank you, PG. Great to be here. I believe it's a strategic advantage that you can have an idea and there are people who are willing to give you funds, to give speed traction, to turning that idea into a viable business. A couple of years ago, we didn't used to have this kind of conversations. It was a lot more tedious, to get an enterprise off the ground. And so conceptually is a great thing. However, it's a two-edged sword, because oftentimes when your idea is not fully formed and then you are awash with resources, there's also a tendency for you to not be as wise as you should be in your approach to growing the business and engaging the market. That's why I believe that the tendency actually, a lot of VCs, like we said before we got on the set, anticipate that 90% of their investments will fail for various reasons. But from a strategic standpoint, I believe it's a great opportunity for entrepreneurs to be able to get ideas off the ground. So today you see people who are working in multinationals, corporate organizations, who see a pathway to entrepreneurship. I see gaps, I see opportunities where I work, and I've also built networks, connections. I know how to navigate the marketplace, and I can access funds so that the gestation period of that idea is a lot faster. Conceptually, it's great. However, it's important to answer the question, what are the requirements? If your intention is to really succeed. It was Carl Rees that said in one of his books, he spoke about the audacity of zero. And what he said essentially is, there's an arrogance that comes with that at companies where you have not done anything, when you're just discussing an idea, or you're still at its incubation stage, you are very confident you are not in tune with market realities. You are not really sure about the challenges of scaling. And so people really just go out all bold. We can do this. If you give us this fund, we turn around.
As you were talking, what came to my mind really is that it's really the audacity of zero, because you talk about people seeing gaps and they think they can do something about that gap, and that gap can become maybe another idea or opportunity and all. But there's just a huge assumption, especially if you are not in the engine room of that setup where you are seeing the gap. Because usually people who lead organizations mind the gap. So when you see them look away from a gap, it may be more than a gap. It may be Grand Canyon that will sink anything at all. But most of the time, young people just see it as in, oh, I can do this better, I can do that, I can. Why are they not looking at that? Why are they not saying that? And that's where the aspiration comes from. But what's more baffling for me is the fact that VCs then throw their money at such seeming assumptions, value that is not substantiated. So when we say that VCs generally feel like if they fund 10 companies and only one succeed, and succeed big, it compensates. Yeah. I'm wondering, and Daniel, I want to throw this at you. Why do you think that VCs are actually willing to go on that paradigm of 1 out of 10? If 1 out of 10 succeed, we don't mind.
I think that concept comes from generally any new business that is formed, what are the chances of survival? So historically, it's typically for every business that is formed after the first 5 years, more than 80% of them are dead. Forgetting about what a VC does, it's just natural. It happens all the time.
So the mortality rate is that high?
It's already high, correct. So if I'm funding that segment of businesses, the chances are that trend will continue, even if they have the right amount of cash. And they also have the benefit in more mature markets in the West of tracking things over a 100-year period, and they've seen it. People have been doing VC investments since before America's independence. They've seen that runway, they've seen the trend. It's cataloged, it's booked, everybody knows about it. So if I'm going out to raise money from VC backers, right, I can tell you that yes, if you take, for example, the fund that invested in YouTube, everything else that they did failed. But that YouTube made more money than every other thing combined when Google acquired YouTube. You have cases like that all through history. So if I'm funding that segment of the business, history is clear. This is what's going to happen. You're not going to do anything differently, right? If that continues, can I still make money? And that's the case that they prove that, yes, we can still make money if we deploy those assets. Because a lot of times, even though that business fails, sometimes the businesses might pivot. So you started out trying to do chips, and then you move from chips to AI. But because of your knowledge and understanding of chips, you do well in AI. So sometimes you segue away and you still make money, but it's already an assumption. So anything extra is just upside for them. That's how they think.
And over the years, that has worked
exactly
to a large extent.
Exactly, correct.
All right. So, but if we just move away from there slightly,
yes, sir.
It then also looks, would I be right if I say that young startups may also feel like maybe if I fail, it's nothing that has not been seen before. Now, even these VCs, it's not like they are really expecting. They know that 9 out of 10 of us will fail. So why should I kill myself? That kind of thing. Wale, what do you say to that?
That's a trick question.
Thank you, PG. And I think, Daniel, you're correct. So historically, 9 out of 10, will fail. But what I would say should be the challenge to the young people, coming up and trying to raise money should then be, should I be one of the 9? Or should I aspire to be one of the 10? I mean, 1 out of 10 will succeed. Should I aspire to be in the bracket of that 1, that 10%, versus being in the bracket of 90%? And there are a number of things to do to be in that 10% bracket. So I cover agri and tech a lot. And I've seen agri-tech companies who just model. You know, you can sit in there and you just model and say, if I plant tomato today, by 90 days, I'm going to harvest tomato. On that basis, you then raise money. Meanwhile, every agronomist knows that you plant tomato today, you wait 90 days for it to start fruiting, and then you harvest the next 90 days. But you have modeled that you will make money in 90 days. Meanwhile, your money is really 180 days. Right. So that assumption will put you definitely in the 90% that will fail. But what young people should then try and do more is to study those that have failed and say, how can I pivot away from this 90% that is failing? And just put myself in that 10% so that when we are then compiling the statistics, I feature more on those that have succeeded. And maybe that could then be an opportunity for me to be able to push out, confidence in what I'm doing, and then funders, VCs can then see me as an attractive, investee.
Yeah, thank you. That's a great thought. But Debo, I wanted to say something to this. From what Daniel said, though it's been historical, but it's still frightening. Right. The mortality rate in small business, development and all that. You are a consultant. Obviously, you should have one or two things to say that can aid, us bringing down this mortality rate. For me, as a leadership coach, consultant, and also a minister, I can tell you for free that one of it is prayer. But I can also say that historically, over the years, a number of businesses that I pray for still don't succeed. I wish I can say, if you have me pray over your business, it's a sure banker, this business is going to succeed. But I've seen it. Yeah, I've gone to stores, different places, pray over people's businesses, and you're driving past in another 2 years or 18 months, somebody else has taken over that store because the business you went to pray over there has failed. Yeah. So in my mind, I'm more cautious as I pray over businesses today. There's no person starting a business that has me to pray that I don't ask, what are you doing? What are your plans? Do you have, have you done your homework? Who are you talking to? And stuff like that. But I just wanted to.
Thank you very much, Vijay. Very, very valid question. In fact, I've reflected on this a bit myself to say, in every area of human endeavor, we strive for improvement. So why are we still in this scenario? And I realized that there are a number of factors. PG touched on one of them, slightly just when you spoke now. And it's about, we need to check the values of the person behind the business. Is this about you? Or are you genuinely committed to that vision? Because oftentimes, the foundation of a business will determine how long it will last. That's one. Number two is you got to look at the processes of the business itself. Have you set up efficient processes? And then I've always said, at the end of the day, the business must be profitable. At the end of every transaction, you must be able to demonstrate that this business is profitable. It was Professor Clay Christensen, beloved memory, one of my mentors in strategy, said something really profound. He said every organization should be patient for growth, but impatient for profit. Meaning that your desire to grow the business should not be stronger than the desire to be profitable. So I've sat across the table, for example, with a startup founder who had gotten some decent funding. And when we're looking at the books, what I found interesting was the rate at which they were acquiring diminishing assets, just because, so I said, okay, let's put this assets that you're acquiring side by side, the volume of your transaction. I said, how long do you think you'll be able to sustain this? Because you now have so much overhead, that you are simply just burning the investor's fund. And I have to say, look, you need to dispose of some of this asset and convert it back to cash. Let's set up a very lean system. And let's determine when we will break even. The conversation didn't go well because that was not, the kind of, expectation. Now we are awash with cash. We should be seen, we should be visible, we should be attractive to other investors. But like, all of that is just a lot of optimism. So just even running an efficient business process is key to success. And many times, the businesses are not set up that way. I feel also that even within the VC community, and I would love you to speak to that, Daniel, there is this pressure. Oh, we want to move from this level of funding to the next, and so we need to get to this milestone. We need to have this capacity so that you're attractive. And so people just get so ambitious and lose sight of the business itself, the health of the business. I think thirdly for me is the HR issues, because an organization is just as good as the quality of people in it. So when you're hiring, what kind of people are you bringing? Are you bringing your friends? Are you bringing in your former colleagues? Are you hiring based on sentiment? Or are you objectively looking for the kind of people that can grow that business and people that can, bootstrap with you? If you hire wrong, it really doesn't matter how much funding or how great your product is, you are still going to fail. And those are some of the things I have identified. And even thirdly is, at times, some VCs just put some kind of pressure on you, or make certain demands of you that compromise your original idea, So those are some of the basic things I've identified that tend to. Yeah. And I would say that I'm pushing this in the direction of Daniel again, that I also worry that some VCs are not really committed to the vision of the startup. It is more about just growing their funds, and we've got to strive for a balance, where in as much as we have that strategic objective, we are also clear about being interested in the businesses that we put our funds in, and we're committed to their growth, so that in some instances we can give them patient capital, And when I hear the story of someone like Jeff Bezos, it took a long time for Google to be successful. And I'm not sure a lot of entrepreneurs here will have access to that kind of patient capital, where your investors keep putting in money, even though the business, is still, recording losses. It took him a while to be able to, and I believe that it was because he had access to that kind of fund. So I feel that those dynamics that are in place, we'll begin to see slight improvement in the percentage of startups that are profitable. Finally, PG, from a church standpoint, also because I'm a clergyman, I believe that this is also a strategic opportunity for the church to begin to look into how we can build capacity and close some of these gaps, character gaps, value gaps, wisdom gaps, greed, ego, some of those things that begin to play out. As a believer, if you're able to overcome some of those, tendencies because you're properly discipled, I believe it begin to play a significant role in how you lead your organization, the objectivity with which you pursue your vision. Thank you.
You're almost tempting me. Thank you for your submission, but you're almost tempting me to say that. So, in the context of a church family right now, we should have disciplinary measures for failed entrepreneurs.
Discipleship.
So that people know that when they want to start businesses, they're not expected to come back and say, "Oh, it failed." If that happened, you're going to be reprimanded, and stuff like that. I mean, I'm just kidding. You know what I'm saying? But it's important that for people to know that it's okay to be a serial entrepreneur, but it's not okay to be called a serial entrepreneur and you don't have any of your ventures that is still alive or that is thriving. You just touch and go, collect money, and it masks your reputation as well. That somebody gave you, $200,000 as a seed funding, and they cannot get anything back from it. Everything is gone, so things just filtering away from your hand. But let's think about it from the VC's point of view. There are issues. Yeah, VCs are like parents. When you say they should be committed to the business of the entrepreneur, if you have 20 children, how many of them can you commit to? to really, so are VCs also playing to their strength in terms of setting up the right structures to be able to cater to these entrepreneurs and fulfill their part? Because it's one thing for somebody to have a war chest of fund and say, I want to be a venture capitalist, but you're not able to set up properly to play your part. It's just like somebody who is very rich but an irresponsible father. Yeah. If you have 3 children, you're able to take care of them well. You have the structure to do so. You can be at their ball game. You can take them to school. You can do homework with them. But by the time you have 25 children, and there's no structure for you to do all their homework for them, to do this, yeah. So what do you say to that?
So it's a function of how the VC is set up. So different VCs are set up differently. In the past, nobody cared how the company does from a governance point of view, from HR, from marketing, from you understanding your cost, your unit economics. It wasn't a thing. Then everybody started studying, okay, look, how can investors help businesses survive other than cash? And essentially that term is known as value creation. So I have given you the money, you have the idea, you have the business. How do we then create value? So what VCs and private equity companies started doing was they started having what you call operating partners, where all that person does is I go and look at the business, has it been set up properly? Are you hiring the right people? Have you done the right analysis around your total addressable market? After your total addressable market, your serviceable market. After the serviceable market, the local nuance of that market. So they sort of sense check the idea of an entrepreneur that is just building something in the sky. The operating partner will bring you down to earth. Now, each VC firms will typically have a deal team. So that deal team will sort of have like a partner and an associate or maybe an analyst that looks after one company. And typically, one partner on a fund would handle about 5 companies. They have another partner handling 5. So they start reducing the size. So rather than just throwing money everywhere, like, no, look, you be limited. And then what happens over time is that partner that did 5 companies, if one of them was successful, the next fund, he already knows a lot about that space, that industry. You take care of this company again. So that sort of helps. We're not there yet, sir, but it's a way we're trying to move beyond, like you said, sir, 25 companies and no parent. Because now we've realized that there is a lot of parenting that has to go into these businesses, given the age of the founders, given what you've learned over time. Right. So we are also evolving as a business to go beyond giving cash and actually supporting them with value creation initiatives. And the final thing I'll say, sir, is there's also the thing of building an ecosystem. So if you invested in 25 companies, but none of your CEOs know each other, they're not speaking together. They're not saying, look, hey, we all need HR services. Why don't we just join forces together and get one solid HR firm? Yeah. Right? So building an ecosystem enables the businesses do better. Because if the companies are talking to each other, like a CEO is saying, I get monthly accounts. And the other guy say, monthly, I don't see accounts in 6 months. Then they start challenging each other like, we can do better. So building that ecosystem is absolutely critical as well. And will help some of these things you just mentioned, sir.
Yeah, that's fantastic. As we start to wrap up, there's an important thing around, especially here locally in Nigeria, where and other part of Africa and the Middle East, where small businesses, tech startups raise money in dollars, dollar-denominated investment. And we've seen the effect of that because they work in a local environment that generates local currency that is highly volatile and unstable. So the currency is sliding down and the dollar is getting stronger on them. What does that look like in your experience?
So it's tough. It also gives you sleepless nights. I'll use an illustration. So you raise money in dollars and you told people I'm going to grow this business from 100 million naira to 500 million naira. And you raise that money at 100 naira to 1. And overnight, 100 naira to 1 becomes 200 naira to 1. So your 500 million target is useless. So to get back to 1, you need to then grow that business to 1 billion. Correct. How are you going to do that? So it makes things so difficult for founders. It's nice you hear the announcements, but it just makes it really, really hard. So that's why I would always encourage, if you can, try and have a mix. Local funding, dollar funding. And as quickly as possible, pay out the dollars and just keep the local funding. I know it's tough. Our market is not as matured, but if you look at the stats, I mean, Nigeria's market cap for our stock exchange in 2003 was barely over 2 trillion. Now it's over 40 trillion. If you look at in 2000, the pension assets was zero, there was nothing. Now it's over 40 trillion. So there are pools of local capital that is available. And people need to start answering the question, how do we get that capital such that we are less dependent on the West? Now, if I want to get a liquidity event, i.e. I'm only selling shares because I want to exit the business, then by all means take dollars because I'm leaving the business. Whatever you want to do with it, do with it. But if it's for growth, as much as you can, try and source for local funding. Even if it means you go to the church, get local funding. It just makes your life easier because then you can plan.
And that takes me finally to the issue of funding and bootstrapping, and the need for people to understand that more money will not always mean better outcome or more success, depending on where you are. Yeah. Wale, you've been involved in a few businesses, whether from running them or funding them and stuff like that. There's a beauty of bootstrapping and being frugal and just doing more with less rather than trying to do more with more. Because in the mind of the average young startup now, you can only do more with more because the funding thing is in the atmosphere. So I wanted to talk about it. How do you compare that to the beauty of the good old bootstrapping and the record of many entrepreneurs we have in different sectors who started with next to nothing, and some of them did not get back to funding until they had an opportunity to be listed in the stock market. They just kept on. They became big to the point that when they would get opportunity for an IPO, that was the next time they really had real big money coming in. What do you say to that?
I'm going to start from what PD talked about when he was speaking earlier. We were speaking about character, those values, that helps you to be somebody that is anchored on basic principles. And we've seen examples. I will use our church, the Elevation Church. We knew how, PG was speaking earlier about, how everything started, and you didn't raise money, but you were focused on doing the right thing and staying in there. That staying power to stay on the right thing and watch the business grow is very, very important. We have examples, Dr. Gabriel Ogbeche also shared today, how he started. I think what is important for entrepreneurs is to know that it's not the fame, and it goes back to those value system. I'm not in this business so that the next year I'm going to be on the front page of the Times Magazine or Forbes and say, the fastest growing. That's the in thing. That's what is really pushing, a lot of people. I sit on both running a business and also funding a business. And I love the Verod approach because I've sat with Daniel Adeoye earlier where he talked about how they started as entrepreneurs. And that really gave them the discipline of knowing how to do unit economics and really stay there and prioritize profit over growth. And it is that capacity and that knowledge that Verod is now transferring into working with businesses and keeping them in the discipline of, it's not about growth. It's not about being in the front page of Forbes. It's about doing the right thing. Even if your capital today is just 50 million, are you profitable at 50 million? Even if it's just, whatever the margin is at the end of the day. Then with the principles you've learned in being profitable at 50 million, how about if you double it? Can you still be profitable? Keeping your overheads fixed. How about if we triple it? So every business needs that sort of discipline. I'm not in for ego. I'm not competing with the next guy or going to be able to say, oh, we just raised our Series A. We are now valued at 500. Every time you raise money, you are taking debt. And God help you if it's dollar debt. And you're doing business in Nigeria and you're only generating naira. You're actually piling up. It's like kicking the can down the road, right? You'll meet it at some point. So every business needs that discipline of, let's just stay on what we're doing. It's like, I'll close with that illustration, the Chinese bamboo. You know, the first few years, nothing is happening. You just, what's happening here? But by the time it gets to that year 5, and then it just shoots, you'll be wondering, where has this been all this while? So every entrepreneur that really wants to be successful and sustainable needs to have those sort of value system. And I believe most of them will have to come from the church, where we can set up systems that actually mentor people and make them to be very grounded, very anchored on those core values, because that is what is now going to guide you as you grow your business. And I believe that that could give us, chances of improved chances of success.
Thank you very much, Wale. That's the much we can take on this Find Your Voice conversation. Thank you, Daniel. Thank you, Wale, and thank you, Debo. I believe you picked one or two things from here. All we're saying is not don't fund your business or don't look for a VC. All we're saying is, what part of the statistics do you want to be? The 90% that has been adjudged to fail, over this period of time, or the 10% that, that deliver, that get things done, that move the business to the next level, who are the toast of the industry when it comes to venture funding. So that's what we're saying, and the factors that can reduce mortality rate in the different industries where people are starting business. And do you want to focus on those factors within your own industry, so that even when you're talking to funding organizations, they know that you know what you're doing and what are you doing to mitigate those factors that has increased mortality rate in your industry. And also, we're also saying that it's important for you to know that there's something called the good old bootstrapping, which is you start with what you have, where you are, and then use your goodwill and your value-driven proposition to get some funding around without it being something that gets you awash with cash, that your work now is managing fund, not creating the value that you earlier also. I mean, some people get funding and then you just see they start investing in stock market because they're sitting on money that they don't know what to do with. Yeah, whilst the money was actually given to you for certain value proposition. So I believe that you've picked something from this, and this is Find Your Voice coming to you on the sideline of the Vantage Forum and the Accelerate Conference from the Elevation Church. It's been nice having this wonderful gentleman on set with me. And until I come your way again on Find Your Voice, my prayer for you is that your businesses will grow, thrive, and become transgenerational. God bless you.